Hi everyone. So let's talk about passage 4. We've already talked about this first part of passage 4 is the issues that there may be. So we need a partnership agreement. We just didn't use the word partnership agreement. So this is the word you have to know. The partnership agreement outlines the rights and responsibilities of the partners, the amounts of capital or assets to be contributed by each partner. So how much is each partner going to put into the business? And how profits and losses are to be shared. So how are we going to share whatever comes out of the business? And if we have to close up the business, how are we going to do it? So this dissolved, right? So that's that exit strategy we were talking about. And this is the most important thing, the exit strategy, because you don't want to get screwed over if the partnership it has to dissolve or the business has to close. Okay, so now partnerships and income tax. It is the same thing as sole proprietorship, almost the same thing as sole proprietorship. So the partnership does not have to pay income tax. Okay, the business does not have to pay income tax. The people, the owners, have to pay the income tax. So partnership does not pay income tax on its net income. Okay, so say we have this business partnership between Crico and Costanza, all right? And they earn a net income of 180,000 for the year. And the partnership agreement says that they're going to share this net income equally. So now, let's say Crico has his personal income, whatever his personal income is, plus 90,000 goes on his tax return. And then same thing with Costanza. She'll have her personal income plus 90,000 on her tax return. So these are the personal tax returns. There is no business tax for a partnership or for a sole proprietorship. That's key, okay? You want to remember that. So that's that. All right. Now, so what we're used to in our chart of accounts is one capital account and one drawings account for the one owner that owns the business. That's what we're used to so far. Now, that's going to change. There is one drawings account and one capital account for each partner. Each partner will have a drawings account and a capital account. So in our example above, we're going to see a capital account and a drawings account for Crico, and a capital account and a drawings account for Costanza. So we'll see how that works out, okay? But before we do that, let's read a little bit. So it's used in the same way. It is used in exactly the same way. So capital increases on the credit side and drawings increases on the debit side. Exact same thing. Okay? So drawings is debited whenever a partner withdraws assets from the business. Now, partner may make, this is the same thing, but it's sort of a review. Why would we debit the drawings account? If we pay salaries to the partner, right? Salaries to the partner are not an expense, not expense of the business. Okay, that's important. It's not expense, it's a withdrawal, it's a drawing. Okay, so the partner may take out assets. So the partner may take the computer from the business and take it home, all right? Or payment of a personal nature. So maybe the partner makes her son's university tuition payment from business's funds. That's a withdrawal. That's same thing as paying a salary to a partner, okay? Because that's personal stuff. We talked about the business entity principle. Remember the business entity principle. Where business is separate from personal life. So any personal payments out of the business will go through drawings, will be a debit on drawings. All right. So again, it should be emphasized that salaries paid to partners during the year must be recorded in the drawings account. Same thing right here. They're highlighting it for you. Okay. So accountants face the difficulties of seeing whether a transaction is a legitimate business expense or if it should be treated as a personal withdrawal. So here's how people try to cheat the government. Okay, so and it's completely illegal. All right. So an owner may say, owner may like, let's say owner one, okay, pays for gas, pays for personal gas, and puts it uh, and shows it as an expense in the business. Shows it as an expense in the business. So now the expenses go up, net income comes down, and when net income comes down, taxes will also come down. And that's why a lot of these people cheat, they get caught, and they're put in jail. Because tax evasion, if a person cheats to reduce their taxes, Canada Revenue Agency does not like that. And this is a crime. It's not, you cannot be put in jail. You can never be put in jail for not paying your loans. Okay, you will be screwed financially, but you will never be put in jail because it's not a crime to not pay your loans. It is a crime to kill someone, just like it's a crime to not pay your taxes. You can be put in jail for tax evasion, for cheating the government and cheating the government out of taxes. So this is illegal. So any kind of personal expense cannot be shown as a business expense. So that's what accountants have a lot of trouble with sometimes, is whether something is a personal expense or a business expense. If it's a personal expense, it goes into drawings. If it's a business expense, it goes in as an expense to lower the net income. Okay, so you have to remember that. Let's go to the next page. So here's how we close the partnership's books. So remember closing entries, we just did that in unit 27. Okay, so I'll take you there in a second. So closing entries we did in unit 27 and you've done before. So this was for merchandising businesses and you've done closing entries for service businesses and previously in accounting 1, and we reviewed it at the beginning of the year. So we're looking at Kriego and Costanza. Now let me take you back to the page where we learned. So page 571 in your textbook, we learned about closing entries for a merchandising company, right? Remember that first we close all the revenue accounts, then we close all the expense accounts along with purchases, right? We did that. And then whatever, in this case, the income summary had a credit balance. So to empty it out, we debited income summary. You studied this just a week and a half ago, so you should remember this. Income summary, we debited to empty out income summary, and we emptied it out into capital. Because we had a net income, we debited income summary for this amount, and we credited capital for that. Now, let's look at what's happening here. Instead of just crediting one capital account, we talked about how Kriego and Costanza were sharing this, equally sharing the net income. That's why you see the net income, $180,000 worth of net income. We're increasing the Crico capital by 90,000 and Costanza capital by 90,000 because they equally share it. This may not be the case. In fact, in this unit, you'll see cases where partners do not share their net income equally. Okay, and once we do the net income, then we learned about emptying the drawings. So drawings will always have a debit balance. So to empty out the drawings, we credit our drawings and then we debit the capital to reduce the capital, because drawings reduces capital, right? We know that drawings reduces capital. So now we do the same thing, but now we have two capital accounts and two drawing accounts in this chapter. Well, in this example, we may have a limited number of partners. Okay, so here, Crico drawing, these are together. Crico drawings is gonna reduce Crico capital, and then Costanza drawings is gonna reduce the Costanza capital. Now, coincidentally, both of these are equal, but it could easily be different. This number has to match with this number because they're both Crico capital, they both belong to Crico, and these two numbers have to match. It just so happens that all four of them match. That doesn't have to happen if they don't share the net income properly, equally. Okay, so those are the two closing entries. Just to show the closing entries of how we close into income summary, close the income summary into capital accounts, and then close the drawings into the capital accounts. Okay, thank you.